Tanvee Gupta joining us now, Chief India Economist at UBS, to discuss the recovery. Tanvee, good to have you with us. Let's take a look at those latest GDP numbers and really what they're suggesting. How are you reading the data internals and the kind of indicators they're providing on the reopening?
Look at the March quarter GDP, the number actually showed a quick recovery of 1.6% year on year. But the thing is that data was before the second wave impacted India. So we are expecting that India to see a downturn in the June quarter. Sequentially, economic activity would have contracted in the June quarter. From September quarter onwards, as we are already seeing on the ground that many states are relaxing daytime restrictions, we do expect normalization in economic activity, especially towards industrial and construction activities, even as restrictions remain for longer for the high contact services consumption. So our sense is that GDP would trend around plus 8.9% year on year for FY22, with most of the downside limited to the June quarter. And we do expect sequential recovery from September quarter onwards. That said, in terms of pace of economic momentum, I think from the second half of this financial, that is between the December and the March quarter, we do expect the pace to strengthen, and that will be in line with the pace of vaccination ramp up, which in our base case, we're expecting it to go up from 2.5 million doses per day in the month of June to almost 6 million doses per day by November.
Right. So do you feel that the impact then of the second wave is likely to be lower, Tanvee? Would you come to that conclusion economically and in terms of the speed of the recovery as well?
If I look at the UBS India activity indicator for the months of April and May, since most of the states announced mobility restrictions, the economic activity has contracted by 12% in last 2 months. If I compare it the same time in April of May of last year, or in fact June of 2020, the economic activity contracted by 24%. So we do realize experience of other countries globally that the impact of every subsequent wave on economic activity tends to be lower because both household and businesses have adjusted to the new normal. So that is the good part of this time. Plus, the extent of lockdown is much shorter in the second wave versus what we saw, an average of 90 to 100 days in the first wave. So that also is good for an economic activity normalization perspective. So we are seeing that from the June month itself, sequentially economic activity should start improving after seeing a contraction of 12% combined in the months of April and May so far.
And give us a sense as to what you believe, Tanvee, could potentially hamper the trajectory of growth going forward. Apart from, of course, what we've seen with respect to the lockdown, do you think that perhaps lack of, fiscal stimulus or measures from the government or could be a hindrance? And are there any other factors that you believe will, hamper the overall growth trajectory?
So first of all, in our base case, the biggest assumption that we are taking is that the second wave appears to be peaking with both the daily case count and the positivity rate going down. And we are not building in any subsequent COVID-19 wave in our numbers. So I guess the biggest assumption or the biggest uncertainty going forward is how the pandemic is going to turn out over the coming months and whether India is going to see subsequent waves. The second is definitely the speed and the pace of vaccination, because that is the critical to reduce the duration of the crisis. In a base case, we are building in that the daily dose of vaccination goes up to 6 million by November, and that's an optimistic assumption looking at the current run rate. But again, if there is any uncertainty regarding the pace of vaccination, that could be a key event to watch out in terms of macro implications. Third is in terms of monetary and the fiscal policy response. So what we have seen right now is that the repo rate is at an all-time low. Financing conditions continue to be comfortable. In fact, despite negative real rates and record low mortgage rates, the credit conditions in the Indian economy continues to be muted. So I don't really see too much of an impact of any incremental monetary policy actions on GDP growth. Yes, monetary policy will be accommodative, policy rates will remain lower for longer, and normalization might happen only from the March quarter of next year. But incrementally, as we have been highlighting, fiscal policy needs to do the heavy lifting. Even if we assume that the government has no fiscal space because we are already having a very tight balance sheet, what we definitely will be looking for over the coming months, if the government is at least able to deliver on the spending commitments it maintained in the union budget. So whether it is putting the money towards capital expenditure, which should be front-loaded because that brings some sustainable growth recovery in the near term. And second, providing some social safety net to the lower income strata. So whether it's front loading NREGA spending, whether it's providing a free food ration to the lowest income strata, and plus working towards vaccination. So I would say, if I just sum it all, number one will be vaccination. The second will be any subsequent COVID-19 wave. And third will be if government is able to maintain its commitment towards spending and towards boosting capital expenditure. Are the three things which I will be watching for having an economic impact going forward.
What about, the impact on rural India? Because that's been quite severe this time around. What's your assessment in light of the high food prices, the inflation, and now they're talking about a delay in the monsoon as well?
In terms of rural economy, what we are seeing is that in terms of daily new case count share, almost 50% of the share is now in the rural economy. So far, agricultural operations were working okay. We saw the mandi arrival data, the procurement operations on the ground. I think till last week of, till mid of May, things were working well on the ground. Only the last week data that we have tracked, we have seen that even the mandi arrival has gone down. We have seen that the number of people demanding work under NREGA program in the rural economy has gone up, which basically indicating some kind of rural distress. We also know that states like Rajasthan and Karnataka had curtailed NREGA operations to ensure social distancing norms are maintained, or they had limited NREGA operations, and that likely to be eased as the situation on the ground improves. So I would say, yes, we are seeing some rural stress on the ground. Monsoons, even if it gets delayed by 3 to 4 days, but in the end of the day, what matters is a spatial and a temporal distribution of rains. So I would still say it could be more a temporary discrepancy or disturbance on the ground, but we will be watching that data very, very closely. The good part is that the rural unemployment levels are still doing reasonably well versus what you have seen to the urban unemployment levels. So that gives you some solace. So I guess the big point is if the government is able to scale up the social safety net programs like a rural employment program in the rural economy to provide some temporary stopgap arrangement to support income levels on the ground.
Sure. Tanvee, wanted to understand what is the expectation then from the monetary policy this week, and do you see the RBI cutting GDP forecast for FY22 from the current 10.5%?
We do expect RBI to be reviewing their annual GDP growth forecast. If you look at UBS estimate for FY22, we are at 8.9% versus RBI forecast at 10.5%. So we do expect them to bring down the forecast. They're always a little on the optimistic side, so maybe somewhere around 9.5% to 10% with highlighting downside risk. In the upcoming policy, we do expect RBI to maintain rates on hold, keep easy liquidity policy as they have been highlighting to ensure that the government's borrowing program goes well. And at the same time, I think if you look at right now the monetary policy response so far, I think the RBI has been very, very proactive. In fact, in the last review meeting, they actually eased and provided some support to the stressed sectors, including SME, MSME sectors. So I would say from an RBI's perspective, easy financing conditions, support to the government's borrowing program, and keeping repo rate on hold for the time being is what we are estimating, with some downside to India's FY22 GDP growth outlook likely on the cards in the upcoming policy.
Sure. Also wanted to understand, what are the additional measures you think the government and the RBI can take to try and support the economy, which is lagging on account of a very severe second wave?
Again, highlight that at a time of an economic shock, fiscal policy is more beneficial versus a monetary policy. And we have seen over the past 1 year that repo rate is already close to an all-time low. Real rates are negative, mortgage rates at a record low, but the credit impulse continues to remain weak. So there is not much scope for any incremental monetary easing to be able to support demand, which means the entire onus shifts on the fiscal policy. Now, if I look at the fiscal numbers, and yesterday the fiscal numbers came out, the actual numbers for FY21, and the central government fiscal position continues to remain stretched at 9.3% of GDP. At this point in time, looking at historically high public debt levels, I doubt that the central government is going to come out with any outright fiscal support or stimulus to, at this point in time, even though I do see scope on the state government's balance sheet to provide some kind of income support to the lowest income strata at this current juncture. So I would say maintain your government spending, front load your government spending, provide or allocate money towards social safety nets so that the lowest income strata, which are the worst impacted because of the pandemic, continues to get some support at this point in time. Don't cut down whatever committed budgeted spending the government had in the union budget announced on 1st of Feb.
Tanvee, great to have you on the show. Thank you so much for taking the time out and speaking with us today.